Good morning, ladies and gentlemen. It's an immense pleasure to be here today at AVCJ Singapore virtually. Thank you all for finding time and visiting the session. Just to start with my credentials, I am the Chief Investment Officer and Managing Partner of TIW Capital Group. Today, we are going to talk about how technology is making private equity stakeholders think about innovation in their own business models. I'm privileged to have a distinguished set of panelists today. Before we start, I'll request them to give a quick introduction. June, over to you.
Thanks, Mohit, and hello, everybody. I'm the founder and chief executive officer and CIO of NSSK. We are a Japan-focused middle market buyout firm. We essentially do control investments, and we transform what we describe as good businesses to great businesses through innovation and operational improvement, and with always a deep commitment to ESG as well. Look forward to joining my panelists today.
Hi, I'm Kenneth. I'm the CEO of Axiom Asia. Axiom Asia is a fund of fund manager focused on investing in the Asia Pacific region. We are established in headquartered in Singapore and established in 2006.
Hi everyone, this is Himanshu Dudeja. I'm the managing director at Blackstone, based out of Mumbai. Blackstone is the world's largest alternative asset manager with close to about $680 billion under AUM. We do the business globally through private equity, real estate, credit, growth, and many other verticals. And technology is an integral part of everything that we do, whether at the investing or the operation stage or within the firm itself. So look forward to exchanging some thoughts and ideas this panel.
Hi, my name's Kapil. I'm on the legal and compliance team at KKR. Based in Hong Kong, covering Asia. We're similar to Blackstone. We across Asia, US headquartered, covering multiple strategies. I've got oversight over all of them. I've got a great team here to help with that. Look forward to speaking to you all today.
Hi, everyone. My name is John Crandall. I'm the Managing Director for Asia Pacific at InCloud Counsel. We're a legal tech company based in Silicon Valley, built by private equity investors and for the private equity industry. We work with over 500 customers globally nowadays, primarily asset managers and their portfolio companies to help streamline a variety of legal operations and really just make their operations much more efficient on a day-to-day basis and unlock data that they have in their business. So very happy to be here today.
Okay, thanks, gentlemen. So the world has changed significantly in the last 2 years, and all of us are adapting and transforming our business models and processes. If the 17th century Renaissance was industrial revolution, I have no doubt in saying that the 21st century Renaissance is technology. Private equity and venture capital industry has been a critical cog in the technology-led revolution. The criticality of technology as an input is also true for our own internal operations. It's an interesting phase in the evolution of the industry. So to start with, Jun, from the perspective of a CIO, how is technology changing private equity firms' investment process and due diligence?
Mohit, thank you for that question. And as you point out, there is no doubt that technology is having a profound impact on not only the global economy, but to our everyday lives. And I would, summarize as CIO, and I think all of my other fellow CIOs around the world are feeling, the same phenomena, where technology adoption for private equity firm is now a must, not a differentiator. And if you look at surveys that have been done across our industry, I'll just share some data. 80% of respondents said that digitalization is going to be absolutely critical for exits and generating superior returns. And more importantly, 93% of my peers said that they will be investing heavily in data analytics. And that's around not only the back office, but front office as well as middle office. So there's a clear commitment to technology investment. I'd just like to make four, points around, these trends and the statistical observation. Number one, I think we all agree that we will need as GPs to embed digital capabilities in all of the processes that we undertake. So as an investor, that means target identification. It means, being able to value firms from different perspectives, which used to be very analog and discussion oriented historically, but one that might use AI in the future. Due diligence will be much more automated as we go forward. And generating projections and looking at historical patterns and trying to understand, where the company might head going forward with the help of with data tools will also become quite critical. So we're going to see more and more of this in our business. And of course, in terms of the middle office and back office as well, there's been tremendous strides made on the fund administration side, and interface with our investors has now gone purely digital. But regulatory compliance, onboarding your portfolio company, and the massive reporting requirements that each of us have are now being better enabled through the advent of technologies. Thirdly, needless to say, being able to digitize your companies is going to go a long way to optimizing returns. And that's easy to say, very difficult to do. And so that comes part and parcel with not only having a very clearly defined digital strategy, but having a digital ecosystem in-house that will enable you to execute that digital strategy. And so that starts with talent development, both training and education of existing personnel, but also importantly, hiring key functional capabilities that one may not have previously had. So I think all of these things Mohit, will be absolutely critical and core as the private equity industry continues to evolve. We're seeing some separation across the industry by firm size, by geography. But again, as I mentioned at the outset, this is a must, not a differentiator.
Okay. I guess on a lighter note, last year even taught us how to raise funds through contactless and through e-route. Thanks, Jun, for that. Moving forward, so every disruption leads to significant enhancement in investor expectations on reporting standards, as you rightly pointed out. Post 2008 crisis, we did see increased LP expectations on disclosure around funds risk profile. So let's get Kenneth's perspective on how technology is changing fund operations and reporting to investors, especially in light of post-pandemic environment. Kenneth?
Thank you, Mohit. Yep. So I agree absolutely with what June has mentioned. If you think about it, technology is a great game changer now, especially in operations. If you look at investor reporting, investors are now increasingly more and more sophisticated. The demands are more complex, and really, if you look at it, people are asking for a quicker turnaround, greater transparency, and frankly, you can't quite rely on what's in the past. Getting teams of people spending a lot of time just trying to compile information for reporting purposes. And that's where technology really steps into place today. Leveraging off a lot of the new technologies, solutions, capabilities that are available today, you find that I think we are able to actually be able to provide more accurate, faster, even real-time information, right, to investors at the click of a button. And that's what we have found, leveraging off a lot of the platforms today. We have used a lot of these new capabilities to kind of even be able to talk about impact of regulatory changes to the portfolio performances. So at the end of the day, I think technology today plays a big part in operational capabilities and in being able to respond to investors' requirements. Yep.
Okay, fantastic. So Himanshu, Blackstone has a long history of adopting to various transformational changes that private equity industry has witnessed. So let me get your perspective on the impact of technology on the global private equity industry. And if you can take an example of any sector where you have seen transformational impact as well.
Sure. Thank you, Mohit, and thank you, everybody. This is such an important topic for all of us to really think about on a daily basis, and not just from conference to conference or quarter to quarter. And I will talk about some of the examples. But firstly, as I mentioned in the introduction, that technology is no more a sector for us. Technology is the core of what we do on a daily basis. What do I mean by that? When we invest in companies, now it is absolutely a must, as Jun also said, it's not a differentiator, it's a must that every transaction, every investment goes through the lens of offense and defense insofar as technology is concerned. What is offense? Offense is, can the technology transform the business that we are looking at any point of time? Where the growth is going to come from, where the value or the valuation path that we talk about, is the technology an enabler there or a distractor? That's the first question we ask ourselves. Then on the defense side, the question we ask is that can there be a disruption risk to the business? As we have seen in pandemic, that strong has become stronger, weak has become weaker. And one thing that stood out as a theme, that whichever business was technology enabled kind of survived, whether it was a traditional business, brick and mortar, real estate, and so on and so forth. It could only survive because there was technology. Therefore, the offense and the defense is the first and the primary question we ask, regardless of the sector. That's point number one. Point number two, we bring in straight away now, not only just from the compliance or reporting perspective, we do a full technology diligence in terms of what's the quality of diligence, what are the operating interventions we will have, the kind of sort of onboarding we will have. It's no more about just the CEO and the CFO of the companies. It's also about the chief technology officer, the real investor backing the business that we are looking at, who really brings in the world-class technology experience. That's point number two. And point number three, I would say that even insofar as the sector selection is concerned, Blackstone is pretty big on IT sector. Now, insofar as IT sector is concerned, traditionally, as we have seen in Asia, you would see data processing, BPOs, IT outsourcing companies based out of everywhere in Asia. But that kind of work is more a commodity work. There is less technology and more of outsourcing. But now the theme that we follow is how do we really create IT companies which allow clients to do cloud migration, data content moderation, and we attract, deliver, or we service clients like Facebook, Deliveroo, Ubers of the world. So we're talking about new age companies which are using technology in a very different way as opposed to just outsourcing jobs, right? So that's on the IT. Now move that IT sector, traditional sector, we have sort of transformed some of the businesses. Recently in India, we had a company called Akash Institution, which was in education sector, purely physical sort of space, tutoring classes. But we brought in technology at every level, transformed the company from a pure education company to a ed tech company. And now it's been sort of strategically put together with the world's leading education company called Byju's. And all of this could happen because we were focused to put in technology right in the middle of that business, which the business had not seen for 30 years. Likewise, a very different example, Star, which was a leading auto component company, but a traditional company, a commodity business, one could say. We came in, we brought in the technology, and we brought in the electronic vehicle platform to that setup. And last month, we sort of took the company public, and it has already become one of the largest companies in the world insofar as the EV sector is concerned. Likewise, whether you talk about finance, NBFCs, all of that, all I will say, technology is something that can really transform the businesses not only purely from cost efficiency perspective, but from a growth standpoint, and can really open the doors which people sitting in one corner of the world can't even think of. On that note, why don't I pause? There are a few things that we will cover in the next sort of topic in terms of how to really bring some of these changes from the operation or operating intervention standpoint. But in the interest of time, why don't I pause here?
Okay, I guess very well said. Technology is a core and no longer just a sector. On that note, let me move to couple. So couple compliance is one of the critical areas where technology has obviously played a very vital role. So what transformations have you seen and evolution you see and you're expecting on the internal systems and processes for private equity firms?
A lot of really good points have been raised. I think what we need to be mindful of is just taking a step back and recognizing in that offense and defense that Himanshu, for example, made reference to, what do we identify when we talk about compliance and legal risk? Is it just anti-bribery and anti-corruption controls? Is it financial controls reporting? Risks of money laundering in any business? Most importantly, today in the environment we're working in, cybersecurity, data privacy, data hosting. ESG, as June mentioned, factors into everything that we do as well. And then there's sanctions. I'm not only referring to obviously US, China, but there's Russia, traditional OFAC sanctions. So when we look at all the businesses, traditionally we'd be on site, we'd be building a relationship with the portfolio companies, irrespective of jurisdiction and industry. It was very easy. So to your question, Mohit, now technology has to step in and make sure we're on top of all those different pillars of legal and compliance throughout the life cycle of our deal, throughout the life cycle of our investment. And so what that means is that we're finding solutions that are not only good for KKR, but also good for the portfolio companies, just given they're at different phases of sophistication. And, you know, an education business in developing Asia is a world apart from Facebook. But you need to be mindful of putting in a platform and making it a proprietary platform for that company that will help them with some basic data analysis and testing, help them actually automate their finance and procurement functions. Also, then help them to automate reporting as it relates to their financial controls. This can be leveraged for internal audit, external audit, but then even back to KKR or any other investors. So once you have that sort of basic framework in place, you are also then able to build out that technology, working with local service providers to make sure that key due diligence items, like when you were playing that offense and looking at that company, are actually addressed in the sense that you have a way of automating basic compliance policies and procedures, automating the training, no more sitting in a room with a PowerPoint deck, but actually going through an automated program, answering questions that can be, you know, self-marked. And so then you're seeing this automatic upgrade in the compliance function through just the use of technology. And it's got to be catered. And technology will allow for things to be in more than just English, allow for things to be catered also for the audience. If you have a large institution in which you've invested and you adopt the trainer model, and you need to be able to simplify the training as they work down their sort of labor levels. When you're training the C-suite, the language, tone, focus is completely different. What that also then means is technology is helping you set up a roadmap for greater enhancements, which you can then pull into the group level. And it'll also, again, provide a framework for reporting to the board and to other management on how to really increase the value of the business overall. When it comes to, again, any investment, we're not buying and selling stocks in the sense that we are committed to the company for a very, very long time. And that also means you can see the evolution of the compliance program throughout the duration of the investment, and you can then test it to make sure that it's been operationalized in the right way, and that also that you can have external parties get access to, say, a gifts and entertainment walkthrough. They can actually run through the whistleblower provisions. They can do a drill. They can send an email. So there's a lot that technology now is allowing for. And the best part of all of this, obviously, is the end report. You've got to give your LPs comfort that you're investing in the right companies. You've got to provide regulators that same level of comfort. And when you can't be on the ground and say, I saw the company, I saw how it runs, I saw their books and records, and I'm comfortable that we've mitigated FCPA liability because everything's in good standing. What you then do is pull a lot of this technology-based information into a summary report, and it keeps you you yourself as an investor or a legal compliance team are feeling, apprised of the developments, but it's the basis for data which you can then feed up to relevant parties. And I think it goes without saying, data is the new currency. And so that is essentially what technology is enabling compliance teams to do, to have some form of currency to use during the life cycle of the investment.
Thanks, Kapil. So I think clearly with what you have said and everyone's pointed out, technology has moved away from just being a product to be an efficiency driver. So with that, I'll just shift gears and now focus to changes in the investment process, especially on the due diligence side. So reliance on technology for due diligence and legal operations has increased multifold in the post-pandemic world, and it's likely to accelerate from now. So John, what is your perspective on the increasing role and impact of technology on the legal side of fund management?
Yeah, thank you, Mohit. Yeah, absolutely. I mean, you're exactly right to say that COVID has really put an emphasis on digitization, of private funds from all aspects, but including the legal aspect. I think we heard from Andrew at KPMG. The professional services providers around the world right now are really just stretched thin. That goes for consulting firms, that goes for law firms, that goes also for in-house legal teams at funds. I don't think that COVID has fundamentally changed the role of technology in the legal operations of funds, but I do think it accelerated a lot of trends that were already here and brought them forward by several years. So just kind of zooming out and thinking about what those trends are, I think first and foremost, and especially sitting here in Asia, it's just the industry is really growing. It's growing very quickly. Private assets under management have tripled in the last 5 or 6 years in Asia, and they're expected to triple again in the next 4 years. That means more investors are coming in, more liquidity. We also see more funds opening up all around the region. Singapore last year registered 108 new asset managers. They're on track to surpass that this year. And that's just one country in Asia Pacific. So that's meaning a lot more competition for investors as well. So what we're seeing in the industry is really more investors coming in, more funds opening up. Investors are writing bigger checks to funds, and all that money coming in is having to be deployed. And right now, I think none of us would have really envisioned it sitting here last March, but the deal-making cycle is just through the roof right now. Everybody is looking at so many deals, and that puts a lot of pressure on legal operations. It means more subscription agreements with your fund investors. It means more NDAs every time you look at a potential investment. When you bring on consulting firms, accounting firms, law firms, you're having more engagement letters. When you're signing up your own tech platforms for the fund, you're signing more vendor contracts. Then you get into the actual investment life cycle. You're looking at more due diligence on all of the potential target companies. On the back end with your fund compliance, you're signing more side letters with your investors, again, because they're writing bigger checks and more coming in and you're raising more funds. So this is really stretching legal teams in quite a lot of ways. The second big trend that we see is simply that legal documentation never, ever, ever gets smaller. It always gets longer. And that's for a variety of reasons. One is just it can be sleepy associates and lawyers and poor drafting, but it can also be responses to regulatory changes. GDPR in the European Union necessitated, data privacy clauses in many contracts that didn't used to have them. Now we're seeing market changes with ESG really coming into focus, and the investors on their ESG front, they're wanting more transparency from the funds, wanting better reporting, wanting covenants around ESG compliance. All of these provisions are making their way into contracts, and that just drives up the length. If you look, so in my prior career, currently I'm a recovering corporate lawyer, as I like to say, but I was an IPO lawyer for most of my career. And if you look at a fund or an IPO prospectus that was drafted 30, 40 years ago, it could have been 50 to 100 pages. You look at an IPO prospectus that's drafted these days, it's 700 to 1,000 pages. They're 15 times longer than they used to be. And that's the same for credit agreements and share purchase agreements and really all around the contractual sort of space. The third trend we're really seeing, and it overlays the first two, is just enhanced regulatory scrutiny. Regulators are devoting more resources to auditing private funds. They're expanding the scope of the audits beyond just purely regulatory compliance, and they're looking a lot at contractual compliance as well. You have contracts in place with your investors. Prove to us, as the SEC or the MES, that you're complying with what you've told your investors you're going to do. So I think these are the three big trends. But as that actually plays out into the adoption of technology in the private fund space, I think we really view it as being split between kind of, let's say, routine legal processes and routine contracts on the one hand, and complex, more high-value contracts on the other hand, because technology impacts them very differently. We see the routine contract side of things being fully automated, fully outsourced relatively soon. I think for a lot of types of contracts, it's there already. Maybe not pure AI-based, but what we call human in the loop. So a mix of machine learning and AI tools, as well as real human lawyers there. We see routine contracting going basically the way of payroll. 20, 30 years ago, everybody had an internal payroll department. Nowadays, external service providers have solved that problem. There's a degree of complexity to the problem. You have to understand sort of the global nature of it. Contracts, even routine contracts, will be different in Asia and Europe and the US because the regulatory regimes are different, the market practice is different. So it does require a degree of sophistication, but people have solved that problem and they can do it pretty well and pretty quickly. On the complex contract side, it's a little different. I don't think the legal tech is there these days to really fully automate those, and it's going to be quite a long time, in my personal opinion, before it will be. But what it can do is it can arm in-house legal teams as well as external counsel to make better decisions faster. So what we see and what we discuss with a lot of our customers is private equity funds. They have so much internal data embedded in their contracts. They have executive compensation contracts that talk about how executives will get paid. They have engagement letters with professionals. They have, for their portfolio companies, they have supply contracts. They have customer contracts. And if you can pull the data out of these contracts, you can really arm the organization to make much better data-driven scientific decisions rather than sort of anecdotal. It used to be, hey, we're doing a high-yield offering opposite some bank. What did you see the last time? And so-and-so says, go ask your neighbor. He did one a couple months ago. And that's not really very scientific. But the use of tools to extract data from contracts and to build precedent data banks and build workflow and reporting tools around it is really arming legal teams very well and enabling them to make really quick, snappy decisions. They can do things in minutes that even 3-4 years ago would have taken hours of prep time and just pulling together and combing through contracts. So ultimately, all of this really just arms the teams to make better decisions and get better economic outcomes, really.
I guess so, right. I mean, from a time and point of view of information overload to relevant information, and that's what technology bridges. So very well put across. Let me now quickly shift gears to the second part. So let's go beyond due diligence and look at post-investment operational interventions, starting with Kenneth. So Axiom is a fund of funds manager speaking both as a LP and GP. In what operational areas would you view technology as a key enabler?
Right. So I think from my perspective, right, actually three key areas. I mean, if looking at the various operations challenges, one of the key area will be in reporting process, how well we can integrate, different data sources across different systems in a very integrated and seamless manner would be one area that, really technology is a key enabler. The second area that, that will be really makes a difference would really be on onboarding process, KYC. As we all know, KYC process, it's not an easy process, right? But with a lot of the new technology platforms, you could reduce a lot of duplication of documents. You could, cut down wet signatures, to and froing of certain documents. That actually makes a difference. And frankly, how quickly and how painlessly you can onboard investors can become a unique source of competitive advantage as well. And the other third area that I think of, it's really on investor relations. There's a lot of good CRM systems out there today that actually helps you be able to monitor, keep track of your investors' information, but more importantly, your interactions with them, and collates a lot of very valuable insights. Ultimately, that like what John said earlier, it really is to help you make better decision makings and tease out insights, that could really be able to address your investors' needs. So in terms of operational areas, I think these are the three that actually would, where technology would really be a key enabler.
Thanks, Kenneth. Just moving to June, what innovations and changes can happen in the operating partner model from here on, given your expertise of so many, interventions you have seen in the past? Jun, you're on mute.
Sorry about that. Thanks, Mohit. That question, I think, goes directly to the heart of a very topical theme, which is digital transformation. And I think it's easy to say digital transformation, but it's always a little bit harder to do. But the reality is that over time, all of us will become somewhat facile at the DX process. Why? Because we have to. And it's going to be a matter of really of survival. And as we think about it, experts have said that there's probably about an incremental $13 trillion that can be added to the traditional, businesses around the world when you look at global GDP by virtue of DX. And so clearly that's something that we need to do. And what that essentially enables us to orchestrate is data-driven decision-making, right? And it's not all about adopting all of the latest and greatest technologies. It's really about leveraging already de-risked technologies that exist in our system. So it's how do we take existing technologies and apply it to traditional businesses? We at NSSK in Japan, have had the opportunity to transform a number of operations in this regard. We owned an analog publishing business that was focusing on manga, or Japanese comic category, had been around for 80 years. All of our editors were people that had pencils stuck between their ears, and no one had a smartphone for years and years. And this company, was typically a 2 to 4% EBITDA margin business. But with the advent of digital transformation, again, which was not easy to execute because it started with strategy, throwing out old conventional ideas about how the business would be run, bringing on board new people, and really changing business processes, from beginning to end. But as a result, this 2 to 4% EBITDA margin business in a span of 3.5 years became a 15 to 20% cash generating operation. So these type of things can happen. And again, it's not through, magic, but again, blocking and tackling and bringing on board new processes. Another example of transforming a traditional business is in the nursing home segment. It's quite an analog business because you still need to care for your elderly patients through caregivers, nurses, and doctors. Hard to use robots, although maybe in 10, 15 years that might change. But in today's environment, then where do you apply technology? And it has to do with sensors. It has to do with monitoring your patients, being able to track people's health conditions remotely without the advent of human intervention. And if you're trying to expand your business, Japan, as you know, has a very large elderly population, and we have a very severe shortage of elderly care facilities relative to the percentage and number of elderly that we have. So we need to be building more homes every day. And site selection is an important and critical part of the decision making. Well, you need to use data analytics, and data analytics will enable you to optimize your decision making in terms of the size of facility, the location of the facility, how far are you to neighboring hospital environments? What is the population? What are the demographics of that population? What is the job to employment ratio in that community? What are the retention rates in terms of labor force? All of these data are critical to making better decisions in terms of where you build that next facility. And even for businesses that are already technology infused, I guess we heard about the ed tech business transformation that was done in India. We happen to own an ed tech business which provides online English and business micro learning services. So it was already a digital business, but we applied AI here to make it more efficient. Typically in a learning environment, you may have a teacher, student ratio, 1 teacher to 15 students, 50 students, maybe even 100 students. But when you start applying AI, you're able to change that ratio from 1 teacher to 1,500 students. Why? Because 90% of the questions that are typically asked by students are common. So you're able to use an AI engine to answer these questions, and your students would not know whether the person responding to your email or text is a robot or a human being. And again, that enables further optimization of your business model. So what I'm trying to say is that in almost every business, no matter how analog in nature it may look, it is not a challenge, but a true opportunity for our industry to be able to transform these businesses. And again, easier said than done, but it starts with having business processes, having an organization, having the right people, and having a talent, management and training setup that enables you to continuously improve what you're working on.
Thanks, Jun. That was quite enlightening. Most importantly, I guess, as populations age worldwide, the role of margin expansion more than growth is going to be a critical driver in terms of returns, and technology is going to be harbinger of that, return driver. So just given paucity of time, I'll request Panshu to quickly talk about the post-COVID context. What changes are private equity firms making to create differentiation, and how's the engagement changing vis-a-vis the portfolio companies?
Yeah, sure. It's a topic that can go on forever, but I'll try and keep it short. All I would say is that one thing that has come out from COVID, that even the private equity investors can no more just sit in their corner offices and just expect growth to come to or from the management or from the operating company. You have to get your hands dirty. You have to be a part of the team. You have to see yourself as a business builder rather than just an investor. And therefore, at Blackstone, we sort of spend a lot of time in cultivating the right team in the operation side, which is we get the operating partner. We have almost as big a team as the investing side to really have interventions post-closing. And one thing that has stood out said post-COVID is that everybody, including the business, has to be agile. you know, you cannot wait for quarters or weeks to see what change is coming your way. So the operating partner or the team has to be on ground zero on a daily basis and really sort of walk the management through in terms of what lies ahead, which is not next year, which is not quarterly, which is tomorrow morning. The business may be very different, technology may be very different, the world will be very different, geographies would be very different. So put all of that together, the way we say it, that the managers are doing their day job and the operating partners are doing their future job, right? So that's the way we look at it. Whether, as you said, whether it is margin improvement, whether it is talent acquisition, whether it is ESG, technology adoption, you talk about inorganic growth, liquidity, all of these things, you know, today cannot be just put on the management, especially when you're doing large buyout deals. If you think about it, as in the moment I even start talking about these items, it just looks like you would require somebody other than the manager thinking about on a daily basis. So these are the things that we try and do other than bringing in the top class management and the technology experts and some of the other good things that I talked about. But the role of the operating partner today is not to just get the reporting done from the management, but is to actually enable the management to think about not only today, but about tomorrow, and really enable them to see what the world is seeing at a global map, sitting anywhere in the world in every corner, is how we see the role of operating partner evolving very post-COVID.
Thanks, Himanshu. Kapil, from KKR perspective, any points you'd like to add on the operating partner model and the role technologies to playing in that?
Sure. Very quickly, just to re-emphasize that technology has really helped us ensure a few key drivers related to compliance and legal interventions, as Himanshu put it, at portfolio companies. And that's really to ensure, one, consistency, so that we've got much more well communicated and consistent values, ethics, policies, codes across our businesses. Transparency, which we spoke about earlier, making sure that all these rules and procedures are well documented throughout the business. And that really helps reinforce awareness, maintain the company's reputation. And at the end of the day, it is going to drive a good valuation because you're being sensitive around risk management and efficiency. And it, ancillary to that, talent retention. If you have a well-run company and you are investing in the technology, it's inevitable then you will retain and attract the right people.
That was quick. Thanks, Kapil, for that. John, just moving to you, my last question. Technology is known to democratize the competitive field if used smartly. The mid-market firms can leverage technology to create differentiation. So in this regard, what are you seeing mid-market firms actually doing to race ahead?
Yeah, thank you, Mohit. Fantastic question there. So in our business, we work with the whole range of private asset managers, from the very large global multi-strategy, hundreds of billions of dollars AUM firms, all the way down through the mid-market to small, even single-family office funds. So through that, we have a lot of discussions with the whole range of sort of the private investment marketplace. And I think what really stands out time and time again, speaking with these customers and potential customers, is simply that the smaller firms and the mid-market firms are much more agile, they're much more nimble than the big players, and that's for a lot of reasons. There's less internal red tape, there's fewer people involved in decision making usually, but also they aren't burdened oftentimes with legacy systems. A system that's been used for 30 or 40 years and has thousands upon thousands of pieces of data that have already been put into it, and if you want to upgrade and build a new system or transition, you need to find a way of getting the legacy system into the new system. So we do find that they are, really very quick to adopt technology, think about it very proactively, and really just build their businesses kind of with technology in mind, almost from the ground up, rather than being forced to kind of reinvent and reposition themselves. So that's on the technology front. I think one of the things we're seeing here, again, just going back to the proliferation in the number of private asset managers in Asia, the growth in the space, it's becoming increasingly difficult to just compete against all the other players in the market. And you really have to go and differentiate yourself in some way. And what we're seeing, especially now, is really just specialized funds really taking off. Either sector specializations. Tech has been there for a long time, but healthcare, crypto, fintech nowadays, as well as regional. So we're seeing a lot of proliferation in Indonesia-focused tech funds. With the rise of the big Indonesian unicorns over the last year or two, that's being a real big specialization, and it just gives them the ability to compete on sort of a ground that they know really, really well, where they have the connections, and they can really keep an eye on the space.
This brings to the end of this insightful session. We have learned so much on role technologies playing on every element of fund management lifecycle. Thanks each one of you in the panel. I don't think so we have time left enough for questions, so I'll just take it back.